Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've talked a lot about the banks in recent days, with the last of the big four reporting full-year earnings this week. EY has just completed their analysis of the 2021 results. Overall, there was a rebound in earnings on the previous year as the impact of the pandemic wore off. But broadly, the sector remains under pressure from subdued revenue growth, low interest rates, and huge competition. Tim Dring is the Oceania Banking and Capital Markets Leader at EY. Tim, welcome back to Fear and Greed.
Great to be with you, Sean.
Tim, it just feels like the banks are a bit of a turning point. They've been these incredibly solid institutions, and COVID hit. And this isn't a really reflection on COVID, it's a reflection on technology. They're just, in this last couple of years, there's so many new players biting at their heels.
I think it is you're right, it probably is at an inflection point for a number of reasons. I think, for many, many years, even coming out of the GFC, their earnings held up pretty well with, very strong returns on equity, 14, 15%. Certainly was the norm right across the board for the banks. We're now seeing that ROE, slightly depressed through COVID, starting to rebound, but it's still south of 10%. They are at an inflection point, you're right, and in some ways, some of their weaknesses have been exposed through COVID. You've seen new entrants being able to migrate quickly to digital, and some of the processing issues that some of the majors have faced in processing mortgages and so forth, has really been evident.
It seems to me that the technology players that have come in, particularly in the payment system area, but also the speed of service, some of those new guys are just better than the banks at speed of service. You mentioned mortgages, but it's almost across the board, I'd say.
Absolutely. I mean, I think whether you look at payments or traditional products of deposits and mortgages, or even just account opening processes, they benefit from one thing, and that is technology. They're working off more contemporary systems. Generally, it's only just one or two systems versus perhaps the significant number of legacy systems that major banks face. Just to process a mortgage may go through more than a dozen systems through a bank. And I think, those sorts of infrastructure setups have really sort of been a hindrance to process and to costs.
I mean, this is in no way any investment advice here, because that's not what we're talking about. But the better technology banks look like they've got a rosier future in some aspects. And I'm not, as I just repeat, this is not an investment show. We're just talking about earnings.
No, look, I think there's no doubt about it. Their cost to income is down relative to the majors. They can act more nimbly. One thing they don't have scale, and they don't have market share.
Yep.
And when I look at the majors, they're still writing more than sort of 80% of mortgages across the market, and that's significant. But having said that, others are biting at their heels, trying to get into that space as well.
Okay, so if we look at the last year, almost 27 billion in cash earnings, and that's up about 55%. I suppose that's off a lower base, though.
Yeah, it was off a low base. The base last year really had the full impact of those COVID provisions that went through. For CBA went through at 30 June, and then obviously the banks, the other three, at 30 September last year. So that was a big impact on the 2020 results. We've seen a number of those provisions reverse, so we've actually seen a gain to impairment charges as some of those provisions have reversed out during this year. So they are still at a level that is higher than pre-COVID, that's for sure.
Okay, so just explain to the listener exactly what you're talking about with these impairment charges, how the banks have to take a charge if they expect loan defaults to be higher. Is that right?
That's right. So one of the key areas of the accounts is provisioning for loan loss, and some of that is the future loan loss, particularly making a determination whether there is going to be a significant increase in credit risk. Now, COVID-19 was one of those factors, and therefore they needed to look right through the cycle, take into account forward-looking adjustments. And I think at the time, if I go back to last year, there was so much uncertainty around COVID-19. We did not know how long this pandemic was going to go for, and perhaps we still don't know in some ways, albeit there is some light at the end of the tunnel. We didn't know whether there was going to be a vaccine. We didn't know how deep this would cut into a number of impacted sectors, particularly retail, particularly travel and entertainment and so forth. So there was a lot of judgment made back then. And obviously with 12 months on, we know a little bit more about where COVID is heading, but we still don't know all the facts. So as a result, they've been, I think, pretty cautious. There's still some sectors in the economy, Sean, that that are yet to rebound, and some of them may not fully rebound.
We've seen a lot of loan deferrals. Now they're coming off now. How will they play out? Because, unlike the big malls, for example, the shopping centres, people actually got rent relief. They won't have to repay what they didn't pay. That's not the case with the banks. If you had your loan deferred, you will still have to pay that loan back and the interest on that period.
Yeah, that's right. Those loan deferrals is really an arrangement between the institution and the borrower, and effectively allowing those borrowers to effectively go into hardship, and there's some certain provisions in there that enable them to work a little bit more effectively with their institution in relation to fees and repayment terms and the ability to restructure the loan. APRA's has provided a number of concessions for banks in respect of those loans, so effectively not treating them as impaired and holding additional capital against them in the short term. So I think that has certainly helped the sector. It's helped the banks really bide time with their customers and try and work through some arrangements, and in particular, customers to work through their own circumstances, whether it be rent relief if you're a business customer with your landlords and so forth, or if you are a retail customer with a mortgage, those separate arrangements you may have with that institution.
Stay with me, Tim. We'll be back in a minute. My guest today is Tim Dring, Oceania banking and capital markets leader at EY. Okay, so we've spoken about credit impairment charges. You mentioned return on equity has come down over a number of years. The other big one which banks talk about are average net interest margins. What are they and what's happening there?
Yeah, well, net interest margin is really the difference between what a bank lends money for and the cost that it pays to deposit holders for using that money. That margin we've seen over the last decade, Sean, just on a gradual decline. We've been tracking the bank results now for more than a decade. And, at the start of that period, margins were well above 2%. We're now down to 1.86%, and that's a fall of 3 basis points from this time last year. What has driven that? There's probably a couple of things. I guess there's some positive aspects on that. The banks have been able to access pretty cheap funding through the term funding facilities set up by the RBA, which enabled them to sort of utilise funding at 10 basis points, which is very cheap funding, in addition to the funding from deposit rates, which has certainly been favourable to the banks. Deposit rates are very close to that, if not zero, for some products. But on the other side of the fence, we've seen intense competition right across the market, particularly in respect of residential mortgages. Probably hasn't been as intense, that competition. We've seen institutions offering sort of cashbacks for refinancing with their institution. We've seen honeymoon rates. We've seen low fixed interest rates. And all of those things have really chipped away at margin. It's actually been quite astonishing, actually, right across the board. And not only that, the heavy bias towards fixed rate loans, we've probably seen a greater tendency of that through COVID than probably what we saw pre-COVID, where there was more of a bias towards variable, interest only, and also lending to investors as well.
If we look at the three that have reported in the last 3 weeks, Westpac's result was disappointing, full stop. No one, and this is based on the share market reaction to it. I think no one's arguing that. ANZ's cash profit was up 65%, but the CEO, Shane Elliott, said they'd missed the home lending boom, which, given what's gone on in the housing market, is significant. National Australia Bank seemed to be more solid, although its institutional business didn't do so well. It must be very hard to run a bank and get every part of it, every division working.
I think that, look, there's a lot of levers to pull in a bank. You try and grow loan volume through incentives. That puts then pressure on back office, and particularly through COVID, where you may have some of those functions being performed by a third party or even offshore, can put pressure on turnaround times and time to yes. And, once again, systems that in some ways are very much reliant on legacy. So that time to yes, can be based very much around manual processing as well. You've then got the margin lever, and, do you compete on price or you're trying to compete on volume? Then you've also got mix of business, and you're right between, retail mortgages, business banking and institutional lending. You've then got the markets business. And then overlaying all of that, you've then got sort of cost levers and, how much do you invest in technology? How much do you invest in sort of operational improvement? And there's so much to continue to invest in just bank resilience, whether it be complying with legislation, building out better risk management processes. All of those things add to the cost base of an institution as well. So there's a lot of levers to pull. And, as I said, trying to get all of them right at the right time, can be a challenge.
Dividends are back, Tim.
They are back, and they're back with a vengeance, Sean. We have seen a number of the banks really increase their dividend payout ratios. I think, cognizant of a few things. One is the return to earnings, which is good. So it's going to help shareholders. But I think the other thing too is the capital base right across the banks. I mean, the capital position across the market is very strong. And, we've certainly seen, a number of the banks, if not all of them, at some point in time start to announce and work through share buybacks simply because they are sitting on a lot of capital.
Yeah.
Capital returns, their return on equity is down, perhaps hand it back to shareholders.
Yep, fair enough. Environmental, social and governance factors, ESG. The banks are certainly more, talking about it more, though, was interesting. National Australia Bank deliberately said it would lend for gas, at least, because that was a transition fossil fuel, is how they put it. Is it a bigger part of their thinking, do you think?
It certainly has, and it certainly has really come to prominence, I think, in the last 12 to 18 months, and probably could say with COP26, it's even risen to the surface a lot faster and more prominent than perhaps we would have thought. But it's fair to say that there's a lot to be done, and we did a big sort of risk survey right across the director base of global banks, including Australian banks in that sample, and CROs. And there's no doubt ESG, in particular the E, is rising to prominence. Last time we did the survey, it was sort of about number 7 or 8 on the list. It's now up to number 1 and 2, depending on what you look at. So, but we're also seeing that play out across, institutional investors and proxy advisors, that the significant focus on that ESG agenda. And through COP26, and I think through what, the announcement from our banks, they've got a pretty critical role to play in that. How they support their customers through this transition phase, I think, is going to be really important. A number have come out and said, they're taking pretty firm stances in who they'll bank going forward. But, that transition play is going to be really important over the next decade as we, start to transition to net zero. But there's a lot to be done. There's a lot of dynamics that play here, Sean. It's not only about perhaps it's a large institutional customer that is the borrower, but behind those institutional customers are shareholders, there are employees, and many of those have bank products and mortgages. So there's a lot of dynamics to work through here, and that is why I think we're probably going to see, this how banks support corporates transition is going to be probably the most critical thing over the next decade.
Tim, thank you for talking to Fear and Greed.
You're welcome, Sean. Thank you.
That was Tim Dring, Oceania Banking and Capital Markets Leader at EY. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.